Bitcoin has this ticking clock built right into its code. Its design guarantees that one day, the creation of new coins is going to stop. Completely. So the big question, the one we're really digging into today, is what happens to the network's security when that main incentive for miners just disappears?
Okay, let's start with the absolute core of Bitcoin's design. It's this number right here, 21 million. That's it. There will never, ever be more. Now, this hard cap is what everyone talks about, what makes it a deflationary asset, but it also creates this really fascinating long-term puzzle we need to solve.
And get this, there's a deadline. Based on the network's pre-programmed schedule, the very last little piece of a new Bitcoin is set to be mined around the year 2140. Now, I know, that sounds like it's ages away, right? But the system was designed to start transitioning toward that moment right now.
And that brings us right back to our central question. If the reward for creating blocks, for doing all that work, drops to zero, who's going to pay to secure the trillions of dollars that might be running on the network? What stops the whole thing from just grinding to a halt?
So here's how we're going to break it down. We'll look at Bitcoin's built-in countdown, talk about how miners get paid today, explore the planned fee-only future, dive into a really interesting game theory risk, and then wrap up with what this all means for Bitcoin's unwritten future.
So first things first, this whole countdown thing, it wasn't an accident. It was coded in from day one. The system was basically engineered from the get-go to slowly wean itself off of creating new coins through a totally predictable and transparent process.
And the way it does that is through something called the block reward, which you'll also hear called the subsidy. Every time a miner successfully adds a new block of transactions to the blockchain, which happens about every 10 minutes, they get a prize of brand new Bitcoin. It's the main reason miners even show up to work.
And yeah, this timeline here, it lays it all out perfectly. The reward gets cut in half about every 4 years in this big event that everyone in the space knows as the halving. You can see the decline right here. It started at 50, dropped to 25 in 2012, then 12.5 in 2016, and on until eventually it hits zero.
Okay, so all of this brings us to a really important idea, the security budget. Think of it like this. It's the total paycheck the network gives out to miners to keep it safe from attackers. And right now, that paycheck comes from two very, very different places.
But here's where it gets kind of wild. Look at how lopsided that paycheck is right now. This chart says it all. You see that huge purple slice? That's over 98% of what a miner earns. It comes from the block reward. And that tiny little blue sliver, less than 2%, that's all that comes from transaction fees.
So this is the big, scary, multi-trillion-dollar problem, isn't it? If that main salary, that 98% of the paycheck, is literally programmed to just disappear, how does the network keep paying for all the incredible computing power it needs to stay secure?
Well, this isn't some surprise. Satoshi actually thought about this. The plan, the intended solution, is for that tiny little 1.8% sliver of the pie to grow up and eventually take over the entire security budget. This is the optimistic case for Bitcoin's long-term survival. And this Reddit comment, it just hits the nail on the head. It perfectly captures that optimistic argument. It's really a two-part bet. First, that Bitcoin's value will just keep going up, making even tiny rewards valuable. And second, that transaction fees are going to become a really big deal.
Okay, so let's break down that optimistic scenario. It's not just one thing, it's a few things that have to work together perfectly. The idea is that as Bitcoin's price goes up, even small fees are worth a lot. And as more people around the world start using it, there are more transactions, which drives fee revenue up. And on top of that, you have layer 2 solutions like the Lightning Network, which can handle all the small, quick payments, leaving the main blockchain open for those big, important transactions that can pay higher fees. It's a really elegant, self-sustaining vision.
Okay, but that's the sunny day scenario, right? It all sounds great, but it kind of assumes everyone's going to play nice and act rationally. But what if they don't? There's this super interesting paper from the University of Zurich that modeled this exact future, and they found a potential crack in the whole thing, a risk that's not about economics, but about human behavior and game theory.
So what these researchers did was pretty smart. They looked at the whole mining game not just as a bunch of code, but as a strategic negotiation between people. They asked the question, when those block rewards are gone, how do miners decide which blocks from their rivals to accept or reject?
And to do this, they used a classic idea from game theory called the ultimatum game. It's actually pretty simple. Imagine I have $100 to split with you. My offer is I get 99
and you get 1. What do? You can take the dollar, or you can say, no way, and then neither of us gets anything. That's the logic they applied here. A miner proposes a block, and other miners respond by choosing to build on it or not.
So, here's the big aha moment from their simulation. When there are tons of transactions waiting, everyone wants to cooperate to process them and collect those fees. But, and this is a huge but, when there aren't many transactions to go around and fees get scarce, their model showed that miners might actually have an incentive to be selfish. This could lead to them rejecting each other's blocks, causing big disagreements about the blockchain's history and threatening the whole network.
And this slide just lays it out so clearly. It's like 2 different paths for the future. On the left, you've got a happy network, high transaction volume, plenty of fees for everybody, and everyone has a reason to cooperate. On the right, well, that's where things get dicey. Low volume means fees are rare, so miners might start fighting over the scraps. That could lead to selfish moves that jam up the whole system. The big takeaway is that the network really needs a steady stream of transactions to stay healthy.
So, where does all this leave us? Well, on one hand, we have Bitcoin's really elegant, almost clockwork-like economic design. And on the other hand, we have the messy, unpredictable nature of human behavior. The future of Bitcoin's security is going to be decided somewhere in the middle of those 2 forces.
And at the end of the day, maybe this Reddit comment says it best. After all the complex models and all the optimistic projections, the totally honest answer is, nobody really knows for sure. We're heading into brand new territory, and as this user points out, there are just too many variables to know how secure the network will be decades from now.
So it all really boils down to these 2 big ideas, these 2 competing visions for the future. The economic view says, don't worry, market forces have got this. High demand and a rising price will create a fee market that's plenty strong. But the game theory view serves as a warning, saying, hold on, if that fee market ever dries up, the system's own rules could push miners toward behavior that breaks the whole thing. Which leaves us with one final question. And it's a question that really gets to the very soul of what Bitcoin is. Can a system that's built on pure, predictable code actually survive the messy, unpredictable game of human self-interest? The answer to that is going to define everything for Bitcoin over the next 100 years.